Good morning, DGens and traders. It looks like another wild day and the markets is geared up. Stocks are sliding, inflation is sticking around like an unwanted guest, and the Fed just slammed the brakes on all rate cuts. If you were hoping for cheaper mortgages, lower credit card interest, or a big rally in your portfolio, well, today is not that day. Let's go ahead and break down what we got from this morning's PCE report. So the latest PCE report just dropped, and guess what? Inflation is still too damn high. The PCE came in at 2.6% year over year, and the core PCE, which strips out food and energy, rose 2.8%. Both numbers are above the Fed's 2% target, which means rate cuts are likely delayed again. This was supposed to be the year of rate cuts. Just a few months ago, markets were betting on at least 3 cuts in 2025. Now, the odds of even one cut are shrinking. Some analysts are even whispering about the possibility of rate hikes coming back. And yeah, that's just what we needed, right? Especially in this economy. But how the markets are reacting, stocks are just free falling at this point. The Dow and S&P 500 dipped, but the biggest loser were the NASDAQ and tech stocks. Why? High interest rates hurt growth stocks, companies that rely on borrowing cheap money to expand. Now, our biggest movers today are financial stocks, which banks are holding up better because higher rates equals more profit on their loans. Tech stocks are getting hammered. Big names like Apple, Nvidia, and Tesla are in the red, and real estate stocks struggling. Higher mortgage rates makes home buying even tougher. Now, Fed Chair Jerome Powell is making it very clear they won't touch rates until inflation shows real progress towards 2%. Powell's stance: we need to see sustained progress before we ease policies. The translation of that is markets need to buckle up. Wall Street was way ahead of itself, picking and pricing in aggressive rate cuts for this year. Now it's back to reality. Oh, there goes gravity. Oh, anyways, what does this mean for you? For home buyers and renters, mortgage rates are staying high. If you were waiting for a rate cut to finally buy that house, you might be waiting a while. And renters, no relief yet. Inflation keeps pushing up housing costs. For borrowers and credit cards, credit card debt is already at record highs, and rates aren't coming down anytime soon. And auto loans and personal loans, those are still going to be expensive. And for investors, sectors like energy and financials tend to perform better in high rate environments. Growth stocks and speculative investments, they're going to be way riskier now. And bonds are looking better. Higher interest rates means better return on safer investments. Now, what's next? Here are some key events that we're going to watch next week. Jobs report is coming soon. If the labor market stays strong, the Fed has even less reasons to cut rates. Next Fed meeting is in March. Right now, the market is pricing in no cuts until summer or later. Worst case scenario, inflation stays high and the Fed has to go even higher with rates. That would be a disaster for stocks, housing, and borrowing costs. Our best case scenario, inflation cools, but not too fast. The Fed wants a quote unquote smooth landing, not a crash. So, what did you think about the results this morning? Is the Fed making the right move by holding rates steady, or should they cut sooner? Go ahead and drop a comment below, and don't forget to like and subscribe for more market daily breakdowns.